What's going on, my fellow wealth creators? Matty Ice here. Welcome to another training. Today, we are going to answer the question, what happens to my cash value when I pass away? So maybe you've got your infinite banking, or you're considering infinite banking, utilizing dividend whole life insurance, just like me. I have my own policy and it's been great. It is such a powerful strategy. And it's one of the reasons I wanted to make this video, because I hear a lot of really bad information, a lot of bad advice. And it's something I encountered too when I started going down the infinite banking rabbit hole, and where I wanted to implement this into my own life. And man, there's just a lot of crap information out there. And sometimes it's used, I think, as a deterrent to keep people from utilizing this type of strategy and just do, buy term and invest the difference or whatnot. I hear Dave Ramsey say it all the time that, the whole life insurance is crap, terrible place to put your money, and that the evil life insurance companies steal your cash value when you pass away. And that is absolutely ridiculous. And it's just, I think it's irresponsible to say stuff like that, not provide the other side of the equation. And like when you structure these policies correctly, and actually you don't even necessarily need it structured properly for them to not steal your cash value, because that's not what happens. But when you say stuff like that, it keeps people from potentially making a very positive, life-changing financial decision like it was for me. And that's one of the reasons I started this channel, because when I started going down this rabbit hole, man, I ran into a lot of really crap information and almost went down a completely different path. And I'm very grateful I didn't. And I'm hoping, just my goal with this type of content is to give you guys information so you can hear both sides, and then you can make a decision from there. You're an adult, you can do whatever you want with your money and your finances, etc. But it's important to make sure you have all of the information. All right, so let's get into it. I should also mention too, if you guys are interested in infinite banking and how I'm using it in my life and just learning more about it, I have some great resources down in the description. Make sure you check it out. Feel free to join my free infinite banking community as well. Lots of really good stuff in there. All right, I'm going to share my screen really quick, because I have some bullet points that I just want to go through here really quick. And then after this, I'm going to pull up my my own in-force illustration for my own policy, and we'll look at some numbers and we'll really bring this home. Hopefully it'll answer this question and give you a lot of clarity around what happens with the cash value. So this is how it was explained to me that made sense to me. And I'm just going to keep this as simple as I possibly can, guys. I don't want to confuse anybody or make this overcomplicated like some people do. I've seen it many times. Basically, what happens with the cash value when you pass away is it blossoms into the death benefit. Okay. So when you have a properly structured dividend paying whole life insurance contract, what's happening is the death benefit is actually growing with the cash value. Okay. Because what you're doing is you're purchasing what's called paid up additional life insurance. Okay. And whatever that amount is that you put in to purchase the paid up additions, 90 to 95% of that shows up in cash value. And I want you to think of the cash value as like the equity in your policy, what you can borrow against to build wealth, acquire assets, just like I am. I actually have two policy loans right now. One was to purchase a vehicle, and then the second one that I just did was to invest in tools and software for my business, because it was like Black Friday and all that. So I took advantage of some really good deals to save money in my business, right? So the cash value is the equity that you can borrow against, and the death benefit is like the actual value of the contract, you could say. And that's going to make sense in a minute when I go through my home analogy. But I've got two basic questions for you here that should really start to sum this up. All right. Would you rather give your family more or less money when you pass? And would you like them to pay taxes on that money or receive it tax-free? They're rhetorical questions, and yet it's not really like the answers and how the contract, a life insurance contract actually works. It's not really understood. And that's why people tend to be concerned about like what happens to my cash value? Why don't I get both the cash value and the death benefit? And when you really think about it, it doesn't make sense for that to happen anyways. But these are, you're going to see why I asked these questions here in a second. All right. Because I'm going to pull up my illustration here. And then the next thing I want to ask you, just to start this analogy, is what happens to your home when you pass away? When you pass away and you pass on your home to your beneficiaries, let's say they sell it. Do they get the value of the home for whatever they sold it for, plus equity or plus all the payments you made into the house? Or another way to ask would be, do they get to keep the house plus whatever they sold it for? No. Like when I ask that, it sounds ridiculous, right? But it's literally the same thing when this question comes up is people expect to get the cash value and the death benefit. Let's say, for example, you sell your house and you've got a mortgage on it. Do you keep the what you sold the house, what you sold your house for plus the equity, or do you just keep the equity? What you sold it for minus your loan, that's your equity, that's your spread. That's what happens, right? But when I ask you, can you keep the full value of the house plus the equity? That's a ridiculous question to ask, right? It's the same exact thing when it comes to a life insurance contract. So let's pull up the numbers here. I'll pull up my illustration and it'll make a little bit more sense. All right. So here's my in-force illustration right here. Okay. There's my name. Yes, I actually practice what I preach. I actually got this in October 27th, 2023. So a fairly new policy, about a month in. And I've already taken 2 policy loans, one to purchase that vehicle, the second one to invest in my business. So actually make that a little bit bigger. Let's zoom in because those are a little small. There we go. All right, cool. Let's back it up a little bit. All right. So yep, I actually practice what I preach. I actually have my own policy. I'm working on getting my second policy right now. So this is really, really awesome stuff when you understand how it works and you don't let these silly questions deter you from moving forward and continuing to learn. So, and here's the, so let's use 75 as an example, because that's when I stopped paying premiums. By the time I'm 75, I will have paid about $1.1 million into this contract. And I've got a cash value of 2.5 million and a death benefit of 3.23 million. So first off, I put in 1.1 million and I'm able to pass on 3.23 million tax-free, no probate, safe from creditors, income tax-free. That's a pretty good deal to me. All right. But let's discuss the issue of the cash value and the death benefit. So when people ask this question, sometimes they think that they should get both the death benefit and the cash value. So first off, if that were the case, we wouldn't have life insurance companies. There's no way to be profitable in that scenario. It just wouldn't work. And that would be very unfortunate because we wouldn't be able to implement infinite banking utilizing these awesome dividend paying whole life insurance contracts. We wouldn't be able to do it because the life insurance companies wouldn't exist, not profitable. So, but using the home analogy, I want you to think of the net death benefit as the value of the home, and then the net cash value as the equity in your home that you can borrow against, because that's basically what cash value is. It's the equity of the policy that I can borrow against to build wealth, acquire assets, etc. Emergency fund, opportunity fund, all that good stuff, right? All right, and there's a lot of benefits to that. But the value that gets passed on to my beneficiaries is the actual net death benefit. Now, here's why this is really powerful. So first off, like I said before, the death benefit is always more than the cash value here. So it goes back to my first question. Would you rather pass on more money or less money to your beneficiaries? Would you like to pass on 3.23 million or 2.5 million? I'm going to go with 3.23 million. But the other benefit and why, see how the cash value is growing and the death benefit is growing every single year, right? So the cash value is basically baked into the death benefit, all right? And we want it that way because the death benefit is what's income tax free. When that's passed on to our beneficiaries, they don't pay income tax on that. If we were to pass on our cash value, whatever the cash value is minus what we've paid into it, kind of like home equity, the beneficiaries would pay tax on that, plus they would get less money. That's not a good scenario. Not anywhere close to as good as the death benefit being tax free. It's more money and it's protected from creditors. It avoids probates, all that stuff. Very, very simple. Okay. But again, imagine if you had a home worth 3.23 million and you had equity of 2.5 million. So in this case, you would still have a mortgage on the property, right? Would you expect to keep both of these when you sell the house? No, absolutely not. You would get whatever equity you have minus fees and all that stuff, right? You wouldn't keep the house plus the equity. You wouldn't keep the value of the home plus the equity. Like insert whatever scenario you want there. That sounds ridiculous, right? It's the same exact thing with a life insurance contract, except it's with life insurance, it's even better because it has all of the other benefits that come with these types of policies. Being able to borrow against it, we get uninterrupted compound growth. It's tax deferred, tax free as long as you structure it properly. It doesn't turn into a modified endowment contract. We can get long-term care benefits from this. We get a tax-free benefit passed on to our beneficiaries. Avoids probate. It's safe from creditors. I mean, the amount of benefits that we get from this policy is just insane. And to think that we should get both both the equity and the value of the contract, I don't know where that comes from. So hopefully now you can see that the cash value, it's baked into the death benefit. We want the death benefit to be passed on, not the cash value. Well, one, because the cash value is already within the death benefit, because death benefit grows with the cash value. But also, we want that tax-free advantage so that our beneficiaries don't have to pay income taxes on the legacy that we pass on to them with this contract, right? So a lot of different benefits. Hopefully that answers the question. Let me know down in the comments. I would love to hear your feedback. If there's something that I need to clarify more, something else you want to see, or something's just not clicking, if you still have questions around the cash value and maybe the difference between that and the death benefit, drop it down in the comments. I would love to make another video for you guys, whatever. But hopefully that provides some clarity and answers that question once and for all, because you don't get both the cash value and the death benefit, just like you wouldn't get both the value of the home plus the equity plus the home, all that good stuff, right? With regards to a home sale. So anyways, hope you guys are crushing it. Hope that helps, and I'll talk to you in the next one.